If I have to characterize today's monetary policy in just one line, I would say as follows. It's a pause, not a pivot. The MPC remains watchful and will not hesitate to take further action in its future meetings as may be necessary. So, the job is not yet finished.
Well, RBI has taken a good call, I think.
That was RBI Governor Shaktikanta Das talking about the reason for the pause which has surprised many in the markets, and the Finance Minister Nirmala Sitharaman also welcoming this development. A very short comment there, but to discuss more on this episode of Easynomics, I am joined by Madan Sabnavis, Chief Economist at the Bank of Baroda, and Orodeep Nandi, India Economist and Vice President, Nomura India. Welcome. The headline that we are really running at this stage is, after 6 hikes, why did the RBI pause? And that's my question to both of you, starting with you, Madan. Why this pause now?
No, I think the RBI did give an answer out there, saying that monetary policy has to be forward-looking. And given the fact that the forward-looking guidance is that inflation is going to trend downwards, there was enough reason for the RBI to feel comfortable that inflation will not be going up from here on, which actually justifies a pause. But this said, I think they have also flagged certain red flags, saying that the recent heat wave affecting the wheat crop, probably the development of an El Nino, what's happening on the crude oil front. I think these are all risks which are there to inflation. And therefore, he has said it quite clearly that there is a readiness to react and turn over and again probably go ahead with the rate hikes in case inflation numbers go out of queue. So I think that's what the justification is.
Orodeep, why this element of surprise? And I must tell our viewers that Orodeep and his institution was amongst the minority who had actually forecast a pause. So why is this element of surprise in the markets, Orodeep?
Look, I think the signals that the RBI had given in its Fed policy is that core inflation is elevated, it's durable, and we need to control this, and it's a downside risk to growth, this high inflation, and they seem pretty ready and to take care of inflation while expressing a lot of confidence that the growth cycle is fine. Now, the key question is, you've already hiked by around 300 basis points or so, right? And you've done it very quickly in less than a year. We are yet to celebrate the 1-year anniversary of the RBI starting its rate hike cycle. And the question is, at what point do you stop, right? Now, one of the reasons why this is a very confusing time for central bankers is that inflation remains very sticky, very elevated. So you really don't know if you've done enough or there's more to be done. And monetary policy acts with long lags. So it's not like you get an immediate reaction. So I guess where we were coming from is that, look, the forward outlook for inflation is relatively moderate. In fact, we are below the RBI's projection. RBI is projecting around 5.2%. We believe inflation is going to be around 4.9%. And we said that, look, the downside risks on growth have really increased over time. And this is one of the points which Governor Das said right off the bat when he started talking. He said that, look, the narrative that central banks globally are going to go for a soft landing is being disrupted. And there are financial stability risks, especially the banking sector risk that's happened in the West. So clearly the outlook on the global side has changed. So in a situation where your inflation is broadly under control, or it's still above the target, above the upper bound, but you expect it to sort of reach a 5%-ish level, and you have elevated concerns on growth, and you've already delivered around 300 basis points or so of rate hikes. Well, I mean, this is actually the perfect time to sort of wait and watch and say, all right, let's see the impact of all of this. And I think a nuance that is very important, Siddharth, is the fact that the governor didn't say it's over and create that market expectation. he tried a lot to say that, look, this we are taking this one meeting at a time.
That's a fairly important point. And Madan, before I come to you again, I just want to play out for our viewers what Dinesh Kumar Khara, the chairman of India's largest banking institution, State Bank of India, said, and I am quoting him: the RBI's decision to pause the rate hike for now was a pleasant surprise, given the market talk of one more final rate hike. With uncertainty looming large, this decision was perfectly timed. Madan, the point about timing that Mr. Khara says, do you agree that it was perfectly timed?
I'm not quite sure if this was the right time, because one could have always argued that with the uncertainty which was there, another rate hike could probably have been invoked, and we could have gone in for a pause, or what the RBI governor is talking of, a pivot, could have been done subsequently. So I think it was a matter of using one's subjective judgment. And here we had all the 6 MPC members voting for a pause. So I mean, it could go either way. Now, is it the right time or not? I think, in a way, if we are looking at purely from the point of view of an economist, saying that what is the real interest rate likely to be in future? So today we are talking of a repo rate of 6.5%, an inflation rate of 6.4%. Now, we do believe here that inflation number in the month of March will come well below 6% and could also go below 5% in the month of April. Now, going ahead, if let's look at the terminal point of RBI's inflation, we're talking of 5.2% in the fourth quarter of next year. We're talking of let's assume the repo rate remains at 6.5%. We're having a real interest rate of 1.3%, which seems to be a fair enough number. So probably that was another justification or another factor which the RBI considered for taking a pause. But to my mind, if we had increased it by 25 basis points, it would not have really done any harm. Because if you actually ask the question of saying that, has growth in credit actually slowed down? The answer is yes, it has, but very, very marginally. If you look at retail credit, it seems to be very buoyant, that the services is buoyant. Maybe it's only the manufacturing sector which is not really borrowing. It's growing at around 5% or so if you look at the February data. And that's also because there's not too much of investment taking place. So the way in which monetary policy works is I increase rates, growth of credit slows down, and I'm able to slow down overall pace of growth. Now just look at it. RBI has actually increased the growth forecast, even though I think in the press conference he has said we're still coming down from 7 to 6.5. If I look at it another way, saying in February they had a forecast of 6.4%. Now they're talking of 6.5%, which means that growth is not going to be affected by whatever is being done on the monetary policy side. So I think that was a kind of a judgment call which was taken.
Oradeep, there was also commentary about over-tightening, and before you answer and explain to our viewers whether indeed there is a shadow of over-tightening also that has been cast over this discussion, I also want to tell our viewers that a very generalized way to explain the lag of monetary policy transmission onto the ground is like a very long goods train applying the brakes. The brakes have to be applied quite some distance away before the train can stop, because the sheer momentum requires pre-application of brakes. So in that context, if 1 year has been spent in taking the repo from where it was to the present rate, is there a shadow of over-tightening as well, Oradeep?
So then, to just extend your analogy, the question is there something on the tracks, right, which needs the train to apply the brakes hard? And look, I mean, if this was a normal year, if this was a year where global growth is fine, probably the answer would have been different. But I think we are in a situation where central banks across the world have sharply raised their policy rates, not just India, US, ECB, etc. And we are yet to see the impact of this policy tightening. So how much growth will actually slow down, whether it will be a recession or not in the global economy, in the developed markets, is still an open question, right? So there's a lot of risks on the growth side. Now, even for India, I think so. There are three problems with the growth cycle. As you know, as Madan said, I mean, I am completely in agreement with him that the current coincident growth indicators, the growth situation as we speak now seems fine, but monetary policy has to be forward looking. So when you look ahead through the telescope, what do you see? First, you see a potential global slowdown coming up, which will impact exports, which will impact investments. Two, you've got a sharp tightening of RBI's own policy. 300 basis points has gone up. Lending rates have shot up. This will eventually start to slow the economy. It's not slowing it now, but it'll take a few quarters for it to again start showing up. And third, private capex has been relatively weak. So, you put all the three together and then you realize, well, how much real rate? Real rate is essentially what your policy rate is minus what your 1 year ahead inflation is. This is just one of the many definitions that you can have. So the real policy rate, how much can I afford? Now, Dr. Patra, Deputy Governor Patra mentioned a very interesting thing in the post policy interaction. He said that, look, in February, the real rate was 0.9%. So my 1 year ahead outlook inflation versus 6.5%, that was 0.9%. But I am more comfortable now with that being 1.3%. So I think in terms of when to pause, it is the question is, well, how much real rate can you really afford? And given the current inflationary situation where you expect it to moderate, to fall in the 5% range for most of the year, and you're in a situation where there are serious roadblocks on growth, I think this is the perfect time as any to sort of say, okay, let's wait and watch.
Madan, this April surprise, along with the April showers that seem to have hit some of our crop, at least particularly in some parts of the north and the northwest, I want to turn your attention towards the housing market. And the reason I am asking you this is in terms of transmission and impact. The first quarter of 2023, despite the hike in interest rates, by all reckonings, it seems to be a continuation of a boom that we have seen in the residential space, especially in the upper end of the market. There has been no impact, and 9.5% could be the number that we need to focus on for the home loan segment. There are similar examples that we can give from other sectors. What does this example of real estate tell us about the impact of tightening?
So actually, if you look at the home loan segment, for example, we see that growth remains as robust as ever. And we should remember that home loans are based on the EBLR, that is the external benchmark. Meaning when I take a home loan, I'm told that whatever rate I am, it's a flexi rate scheme which I get into,
Yes.
it's going to be linked to the repo rate. So if the repo rate was 4%, let's assume I was getting it at 400 basis points higher than 4%, I would be getting it at, say, 8%. And today, when it's 6.5%, it automatically becomes 2.5%. Now, the curious part is that even though the rates have gone up, we have not really seen home loan growth slow down. But the reason is that whenever anybody goes in for a home loan, you are very well aware of the fact that in a period of, say, 15, 20 years, when you will be servicing this particular debt, there will be phases when interest rates go up, there will be phases when it comes down. And you may not be hit directly because you go on the basis of AMIs, which may not exactly be for 10 years or 15 years. It could become, say, an additional 6 months or a year, depending upon how the interest rates move. So I think that's one of the reasons as to why the mortgage segment has been very buoyant. And that's something which is being focused on by all banks. And that's what we're seeing, that there's a focus on retail lending, home loans. And that itself is putting pressure in terms of overall demand in the market. That's why we're seeing that the real estate sector is doing very well as of now. Not just in terms of the premium residences, which anyway do have demand most of the time, but even if you're going downwards, down the pecking order, there has been very good demand, aided also by the fact that one was getting loans at fairly competitive rates.
Auradeep, on the inflation picture, and I keep repeating this in every conversation, I'm sure you will agree that it's an important point. The fact is there has been no pass through of crude price volatility. uh, because the government has sort of taken the hit, the oil companies have taken a hit. We don't know what will happen. We are seeing some of the impact of the production cut already start seeping into the markets. Minus of the pass through of petrol and diesel in terms of inflation, do you really think that inflation is tapering down?
So one is an arithmetic argument, which is what is known as base effect. Inflation has been pretty elevated for the past couple of years. So it's because of that high base, the current year-on-year numbers are expected to be low. So one is that's arithmetic. That just gives you a nice picture on the headline side. Look, I mean, the key issue which one looks at when you look at inflation is, what is the core inflation side? So there are three sides. One is food, one is core, and one is the second round effects of inflation. So high inflation sort of leading to high inflation later. Now, in the case of food inflation, there are upside risks. I mean, obviously, because there's the heat wave that could impact wheat production. You could have there's talk of El Nino. Again, we don't know if there's going to be a drought or not. But even if there is a drought, the link between food inflation and drought hasn't always been perfect. There have been times when inflation has been fine, even when rainfall hasn't been so. And so there are risks there. But overall, I mean, the Rabi crop has been pretty strong, and the RBI governor also flagged this. So, there is that. It's in the backdrop of that. So one can only assume a normal monsoon and make some of these projections. The second issue, and probably the more important one for the RBI, is what's happening on core inflation. Now, what firms have been doing for the past many months now is that commodity prices were elevated, higher input costs. They were passing on these costs to consumers in order to repair their margins, right? And that process is still continuing even as commodity prices globally have crashed, input price inflation has gone down sharply. So then the point is that, well, there will be, a juncture where you've passed on whatever higher input costs were there, and,
Right.
from that perspective, you have some relief. And on the core services inflation side, you actually see that we are seeing the trend peak. And very quickly on the third point, which is the second round effects, inflation expectations remain broadly under control. The house rent inflation, which is something that we watch in terms of second round effects, while increasing, still remains pretty much under control. Wage inflation also, I mean, it's been relatively capped so far. So we don't really see those second round effects feed in, which is why we think that inflation might actually end up surprising on the downside. Not to mention that all of this comes under a very challenging growth environment, which in itself will apply disinflationary pressure to inflation.
Absolutely. Oradeep, thank you very much for your time with us today. I know you have to go, but I'll continue this conversation with Madan. Madan, if it's a pause for now and not a pivot as the governor said, do you expect a pivot to happen?
No, I think the MPC will be very watchful of how the inflation trajectory moves. As I mentioned, the next 2 months, that is from March and April, we will be getting low numbers. I think the important part will be as to the development of El Nino. Because we have seen in the past that when we've had an El Nino event, and by the law of probability or just looking at past patterns, this should be a big event rather than a small event. We can distinguish between big events and small events. The last big event, I think, was in 15-16. So every 7 years, we have a big event. There will definitely be an impact in terms of certain agricultural crops being affected, because we have seen the pattern of Indian monsoon is such that even when we have a normal monsoon, especially the hinterland, the rain shadow areas which grow primarily oilseeds, pulses are the ones which could be vulnerable. So I think the RBI will be cognizant of this particular fact, and they will watch to see as to how the monsoon fares, how specific zones react to this particular monsoon shortage, or whether, if at all, there's a drought anywhere, and accordingly take a call on whether you need to actually change the boat turnover and then say we're going to start lowering the rates. And even given the fact that I thought that in this particular policy, even if there was a rate pause, there was a good reason for one to change the stance, but the RBI has felt that we are still in the accommodative mode, and the accommodative mode has been defined by saying that the inflation is 6.5, repo rate is 6.5. In 2019, we had 2% inflation, 6.5% repo rate. Therefore, the stance is still accommodative. There's lots of accommodation in the market. I would tend to think that probably September, October, after evaluating the situation, there could be serious consideration of whether to lower the rates. That is when you probably go in for a pivot. Not before that, and in between, we of course have the oil impact, because at some point of time, the government will also give, and they may start increasing retail prices. And while we were talking of the fuel part, we should also remember that while petrol and diesel have not been affected, the price of LPG has been increased continuously. I think that's one thing which we tend to forget, and that's adding to overall inflation. So I think probably September, October, not before that, when it could be reconsidered.
Okay, viewers, what Madan Sabnavis is saying is that if it's a pause today at the beginning of the financial year and the first week, within the first week of April, he's talking about a possibility of a cut in September or October. Now, this is obviously a possibility and a significant one at that. What would be the circumstances that would merit a cut? Because for all practical purposes, we could now also run a headline as you speak, Madan, that you believe that this is the end of the hiking cycle.
It looks very much that it's the end of the hiking cycle, because I do not expect this inflation number to turn nastier from the 6.4% which we have. And going by the RBI's projections on inflation, we're actually talking of the number moving well below 6%, and you're ending at 5.2% in the fourth quarter, which means that as long as we have this difference of 1.2, 1.3% real interest rate, there will be no justification for increasing the rates. But there could be a judgment call at some point of time saying that we've always seen that inflation numbers tend to surprise us, where we could be getting low inflation numbers, say for 3 successive months. Let's assume they get less than 5%, then probably we could be talking of an interest rate cut. So what I meant was that until September, October, until we assess the monsoon situation, there's definitely no case of thinking of a pivot. But maybe in case we do see that we have good monsoon, wonderful monsoon, production is very good, likely to be very good. In that particular case, I think there would be serious consideration, and post September, October, there could be a cut considered.
Okay, and remember that this is also pre-election year. We are practically now just 10-11 months before the first votes of the next general election are cast, and therefore the point about petrol diesel is going to have a significant play. If I were a new borrower, Madan, and this is my final question for today to you, if I were a new borrower, either for maybe a two-wheeler or for a smaller ticket size house, what should I be doing now?
No, I think if one is a small borrower, and typically I think the example which you've given, you would be working on the basis of an external benchmark. So you need to look at the external benchmark rate of various banks, and this would probably be the right time to borrow. Right time, when I say, is that things are not going to get worse. They could get better in course of time. It may not happen in October, as what I was saying. It could happen maybe in December, or maybe not at all. But definitely, there's not a case of saying that interest rates are likely to go up. So therefore, I think anybody who wants to borrow right now should look at your own debt servicing capability as of today, saying that interest rates are, say, 6.5% plus whatever spread the banks are charging. And if I'm able to pay it, I can assume that at least for the next 9 months, there will not be any rate hike.
Madan, I asked you that question because this is the question that is asked the most after every policy, and while we digest some of the macro, this is the real micro question that a lot of people ask. And I would just add to what you said, Madan, that I think there's also the concept of opportunity cost. If you are in a position to fulfill your dreams and fulfill a part of your aspirations, go for it. These are cyclical events, and you can perhaps never time the market in any manner. Madan Sabnavis, thank you very much for your time with us today. With that, it's a wrap on the policy coverage here on Business Today Television and Easynomics. I hope you liked our presentation today. We'll be back with more. Do stay tuned in, and until then, I will remind you once again to like, share and subscribe to Business Today Television. Goodbye.